What is going on with housing? Applications are on the rise, but pending sales are the worst that they've ever been. Why is this happening and what will happen next in the housing market? Let's dig into what is going on. So, number one, this is the Mortgage Purchase Application Index. It's seasonally adjusted. This comes from Resi Club. It shows that these purchase applications, right? Somebody reaching out to a lender saying, hey, I want to buy a house. Can you pull my credit? Can you run my finances? Let's take a look and see what the monthly payment is, and I'm going to get pre-approved to buy a house. Well, this has been slowly drifting up over the last year with more and more applications, but this unfortunately is not leading to more people buying. And in fact, a lot of people who are doing their applications are getting flat out denied for various reasons, including obviously job loss. Their credit is not good enough, or they're looking at the monthly payment and they're saying, hey, this payment makes no sense. I'm just going to go back to renting. And it's showing up big in housing in specific areas of the country. So this report just came out and it shows that there's record low contract signings to close the end of 2025. December was the lowest level of pending home sales on record since it was started being recorded in 2001. Look at this incredible drop off. We had this massive run up over the last decade or so, and then especially when rates went to zero over the zero interest rate policy, tons of pending sales, pending contracts, and then right in March 2022, when the Fed raised interest rates, boom, we saw the contract signings drop. And not only that, we saw obviously we had the interest rates go higher, and for a lot of people, it priced people out of the market. But even with rates dropping from essentially 8% down to 6%, it's still not enough to pull buyers back into the market and continue to get sales to move forward. So we are at, again, a record low in December 2025 for pending sales. And this means that these will close in 30, 60 days out in 2026. And it indicates that we're going to have a weak opening to 2026 based on the numbers that we're seeing today. Now, this is where the pain is currently. You can see here in this chart, this is from the National Association of Realtors. You can see across the United States versus last month, we're down 9.3% in pending sales month over month. And versus last December, we're down overall 3% in pending sales. Now, not every market is exactly the same. It may surprise you that the South is actually decreasing the least amount. Well, there's a lot of decline in prices. There's a lot of builders who are getting desperate to sell their inventory, and they slashed prices by the end of the year to try to get the transactions to start moving forward. But we're actually starting to see issues in the Midwest, in the Northeast, and in the West and other areas of the country. We're seeing the pending start to slow down. And this is what we talked about. Yes, the Sun Belt will get hit first, and then over time, other areas will slow too. The inventory will stack up month after month after month. And then, of course, we'll have a oversupply of inventory. Prices will then come down. Real estate's an illiquid asset. It takes time for these assets to adjust in price. And pending home sales is a great indicator of, hey, this is what's going to be happening in the next month or two in terms of what we're going to see with closed sales. All right. So we have the pending home sales, and then we have the fall through rate of those pending sales. And then you subtract that from the pending sales and you get closed sales. And we're seeing closed sales near record lows as well, because we're seeing fall through rate increasing as well. Buyers are getting sticker shock. They're seeing the condition of the home and deciding during inspection, I don't want it. They're negotiating with the sellers, and it's a tough negotiation. They're saying, you know what, it's not worth it. I'm going to wait a little bit longer in rent, and then I'll buy down the line when prices are a little bit better. And so buyers are holding off and sitting on the sidelines. They want to buy, as you can see from the mortgage applications. It's just a matter of the price. And once these buyers see the numbers, they decide to wait and rent. So this is buying versus renting in America. With home prices and mortgage rates both rising, the U.S. has witnessed the biggest numerical gap in the cost between owning a home and renting over the last 50 years. This chart says it all. However, we have seen scenarios, haven't seen similar scenarios since the 1980s. And I'll show you an article from the 1980s to put things in perspective. But you can see here the cost to buy is $2,600, $2,700. You could rent that same unit for about $1,800. Why would you spend about $900 extra dollars per month to buy a house when you can just rent one and not have to deal with the repairs and maintenance and taxes and insurance and HOA fees and all of the other things that come along with buying a house? This is a great chart. It comes from Visual Capitalist, and I highly recommend you follow them as well. And look at this. This is another chart. It just shows you payments have increased since 2021, 2022, all the way up to, 62% increase in payments. This is not sustainable for the next generation. First-time home buyers are getting locked out. Locals are getting locked out. The people who are purchasing are older in general, and they have a lot of money, and they're relocating to areas that they can cash out of their existing home and buy a new home and even purchase it in cash. About 28% of sales right now are cash purchases to get away from this mortgage payment because everybody's dealing with these higher interest rates. Obviously, we had zero interest rate policy for a few years. That drove up prices. The Fed came in and just jacked the Fed funds rate up. That influenced the mortgage rates up. And now we're in this situation where the payments have jumped from 1,600 to 2,600. And this is what's starting to happen, right? You can see at the same time frame, you're seeing this divergence of, oh, buyers no longer can, the red line can no longer afford. So the buyers are dropping out. And then sellers are saying, hey, I still want to sell. And it starts to stack every single month. The gap between home buyers and home sellers continues to widen. You can see the buyers are kind of dipping off here at the beginning of 2026, and it's going to show up big in the market. Affordability is the number one thing that's holding the market back. And everything that the government does tries to prop up the prices and continue to keep the prices high. But ultimately, what the buyers need to get into the market is lower prices. And I think that's healthy for the market, especially after seeing more than a 50% run up in just a few years. We need a healthy correction here to move forward, and we're already starting to see it. This is the share of estimates that are down over the last year. 53% of MSAs are now down, or cities are down in their prices, right? So the tide is turning. This is not just happening in the Sun Belt. This is starting to happen in the Northeast and the West as well. I know a lot of people say, well, it's not happening in my area, not happening in my area. It happens slowly, so you don't feel it until you start to realize, okay, the buyers are really backing out, and it all comes together. And we're starting to hear reports from the Northeast that things are really starting to slow down. Yes, we have some seasonality at the end of the year and the beginning of the year. Absolutely, this is true. But the problem is the affordability is getting worse in those areas as well. And so this is the article I wanted to share with you from 1981. It was written by Wallace Kaufman, August 9th, 1981. And we look back at that chart, right, saying the divide between cost to buy versus rent. This is exactly what, history rhymes. We're seeing this from the same exact situation happening today in a lot of ways. It's very similar. The New York Times article, the only real way to freshen the stagnant housing market is to get things sold is to lower prices. Exactly. New home builders have also been cutting prices, but disguising the fact and reduce interest rates by use of a device called a buy down. We're seeing this exactly the same thing, right? Builders are buying down their interest rate, buyers' interest rates all the way down to 3 to 4%. When wishful thinking about lower interest rates comes to an end, prices will be falling all over the place. And that's likely what we're going to see next, right? This part of the cycle, we're near the peak or right past the peak, and prices will start to step down every single month. We're seeing it first in Florida, Texas, Nevada, Colorado, and it's going to spread out to the rest of the country over the next few years. And this is the scariest chart of them all. This is the first time home buyers are disappearing. This is an estimated percentage of 30-year-olds who are both married and homeowners, and it's dropped all the way above 50%, all the way down to 12%. This is insane. So people are waiting to buy their house. They're waiting to start families. They're waiting to get married because the cost of living is so expensive, and they're loaded up with debt. And of course, this is causing birth rates to decline. We want, as a country, in my opinion, prices to be affordable for the next generation to get in. And I know a lot of people say, well, we can never let prices go down. Well, they went up 50, 60% within 5 years. It's totally fine if we have some mean reversion. It's not the end of the world. But the numbers that I'm running show that we should see a 31 to 40% decline in prices here in the Sun Belt based on the numbers that I'm running in my investment models, which if that happens, it will be really painful for the people that bought in the vintage year of 2022 to 2025. If they bought it way earlier than that, 2019 prices, they'll probably be okay. So it really depends on when you purchase the asset in terms of how it's going to perform moving forward. And look at this. This is another chart, the similar vein. Share of first-time home buyers is declining, right? It used to be in 2010, 50% of the buyers were first-time home buyers. Now it's all the way back down to near 20%. Terrifying chart. This just shows you that the market is not healthy. And you have to think as an investor and as an owner, who will be the next wave of buyers who are going to purchase my house at a higher price than it is today? And what are the fundamentals that support that? Come up with your thesis, come up with your data to back it. But this is obviously information showing that prices need to come down for these buyers to be brought back into the market. And for people who are already purchasing right now and still buying right now, look at this. The median age of all home buyers right now, not just first time home buyers, all buyers, is now 59 years old. This is up from 31 years old in 1981 from that article that we are just talking about. So over these years, it's just gone, it's basically doubled the age of the home buyers, and this is really terrifying. It's the same people that bought 20 years ago who are basically selling their house and buying it now, and the rest of the society and the middle class and the working class is priced out because it's so expensive at the pricing level. And I know the government wants to do everything except for prices to try to get the next generation in there. I appreciate them trying to solve the affordability issue, but affordability at the end of it, I know it's based on payment and that's partly interest rates, but we need the prices to come down. That is the major variable that people need. And frankly, these folks who are nearly boomers, right? Boomers are 61 years or older. They're giving up their low rates actually right now. We're starting to see some stats come out. They're saying, you know what, I'm going to give up my 2%, 3% rate that I refinanced in 2020, 2021, and I'm actually just going to go buy the house that I have. And they're unlocking their equity and they're bringing prices down when they're doing that in a lot of cases in specific areas of the country. And the other issue with these first time home buyers is they're loaded up with debt. Look at this, the student loan delinquencies rising, we have credit card delinquencies rising, we have auto loan delinquencies rising, and they're just loaded up with debt. They have co-borrowers on a lot of this stuff. Their credit's getting hit. And the first time homebuyers also that we notice locally, they're getting down payment gifts from family members to be able to make it happen, because in some cases you need, I know, 3% down and all this other stuff. You don't really, the payments are really rough when you only put 3% down. If you can put 20% down and get rid of the PMI, that definitely helps. And people are starting to get gifts to make things happen, which is fantastic. However, they're buying at the peak of the market. And so that equity that they have could evaporate very quickly. They need to be able to hold these homes for a longer period of time to prevent them and have that pay down to prevent them from having issues. Because the reality is most people move houses every 8 to 10 years. That's the average duration of a loan, is when they get their payoff and they move. So if you buy at the wrong part of the cycle, you could have no gain or a negative gain depending on what happens with the demographics and who the next buyer is and the level of supply in that area. So you do need to be careful and negotiate like crazy to minimize your risk. If you need a real estate agent in your area who's a top agent who understands this, reach out to me, make a comment or send me an email. My email's down in the information below, or you can find it in the YouTube page. Happy to connect you with some of the top people in the area if you're looking to buy or sell. As you know, 74% of agents didn't even sell a house last year. And you don't want to get stuck with somebody who's doing their first transaction, or you don't know how to do the diligence on them to make sure that they're actually good. But it is still, right now, this is again why prices are going to come down. It's cheaper to rent than to buy. And I keep hammering this point across in each one of these videos because these potential buyers are smart. They're going to find a path where they're going to minimize their expenses to the most amount possible. And they're okay with renting. They can rent new construction in a new construction community. They can rent all these luxury apartments, and rents are coming down in a lot of markets. They're able to negotiate lower rent, which means that the opportunity cost is getting wider. So I do think that prices will come down. I would love to see wages go up, though I'm not optimistic about it at this point in the market cycle either. Hopefully we don't have too much job loss, although we're seeing like record announcements of layoffs. So we're seeing all these data points. I want to be optimistic on the market, but every single day there's more data points that come out that, point to a downward trending market. Just like I talked about at the beginning of this video with the pending home sales being the worst December ever since 2001. So I'd love to hear from you. Will the housing market take a bath this year in the Sun Belt or in your area? Comment below where you're located and what you're seeing on the ground. If you're a renter, are you thinking about buying? If so, why would you buy at this point in the market cycle? I'd love to hear your reasoning about it. We're always connecting with top people around the country and learning from each other and understanding that real estate is micro and regional. So every area has unique factors associated with it. So it's not going to look blanket across the board. There's going to be magnitude, direction, and timing. Those are the three factors that you have to watch out for. Timing's really hard to get right. Magnitude, I think the Sun Belt's going to have the largest magnitude because there's overbuilt, overspeculated. What happens in the Northeast, I'm not sure the magnitude, but the direction is likely negative for the Northeast as well. There's various factors with that, and I'll be getting into those conversations with Melody Wright, who's a colleague of mine, who'll be explaining why it's going to hit the entire market, not just the Sun Belt, but there will be a difference in magnitude. So as always, you can follow me on Substack. My information is below. You can also follow me on X at John Brooks. I post daily on X so you can get the most up-to-date information. Look forward to seeing you soon. Thanks so much for watching.